Well, so here's the puzzle from our view of it, is that we've seen institutional investors reducing risk since February, and yet the markets continue to go up.
Yeah.
And so, I think we're just concerned that it's a bit vulnerable right now, the market, in the sense that institutional investors have not been behind it. And also it's very narrow, the rally as well, which, again, would suggest that looking forward, if the market's only running on one track, you get one shock to that track, and you get more volatility.
Yeah, where do you think that shock could come from? I mean, in this first half, we did see that commercial real estate market also become a bit of a worry for the banking sector too, but tech just seemed to have held up everything else. Where do you see a shock coming through here?
Well, I mean, look, this is the interesting thing, is that in the first half of the year, we've had a long list of shocks that have come, and even last weekend, goodness, that was potentially another one.
Yeah.
But I think you have to assume it's going to need to come from earnings, and maybe it needs to come from earnings, in tech, because that's where all the optimisms have been embedded. What it unlikely to be is the recession news, because you've got to assume that investors are somewhat ready for recession. So I think it's just going to be something that challenges the assumptions that tech is a safe haven.
It's funny you say investors should be ready for a recession, because that's the opposite of what central banks have been telling us. We saw that yesterday at Sintra. They were saying, look, we're still hiking, we're not done yet, but don't worry, we're not heading towards a recession. Do you buy into that? Do you believe the likes of Jay Powell, that he can keep on pushing up rates possibly another 2 times back to back in July, September, and not trigger a recession?
Yeah, I mean, I think the market, the yield curve, which obviously has always been the best forecaster of recession, has been calling for a recession for quite some time. Yeah, and most models still are warning of recession. And look, and obviously in parts of Europe we're already in recession. So look, it may well be in the US that the recession is quite shallow, and so that's something. But I think a deep slowdown in global growth seems to be inevitable.
Let's just tackle the pathway for interest rates, because you've done a terrific report just going through the various different components of inflation and where there has actually been change. One of the elements that Jay Powell was particularly still concerned about was around the services side. Yeah. And looking at your core service sector inflation gauge, there are signs of hope, reading between the lines.
Yeah, a little bit. And so, look, we were trying to score inflation from both the first round effects and second round effects, and trying just to tell whether it's come back to normal. Because, I mean, in the end, that's what we need. We need a normalization in inflation. And right now, I think Powell was kind of alluding to some of this yesterday, is that many of the measures we look at are getting better, but they're a long way from good enough. And so, look, so service sector inflation is beginning to come down, especially if you take out rents. You have to take out rents. And I think waiting for the housing market inflation to correct is one of the big hopes for inflation in the second half of the year. But, it's like a car journey. We're just not there yet, unfortunately. And that's why central banks have to, maintain this stance that rates might need to continue to go up.